Something just broke in the global reserve system, and nobody noticed. While the entire financial media has been fixated on China's aggressive dumping of US debt, while every analyst is screaming about Beijing's economic warfare, while the headlines scream China sells treasuries, a second signal emerged from the other side of the world. The signal is quieter, more subtle, and far more dangerous. Because when China sells, everyone expects it. They're the adversary, the geopolitical enemy, the trade war opponent. Their selling makes sense. But when India sells, the narrative breaks. India is supposed to be the democratic ally, the counterweight to China, the partner in the Indo-Pacific strategy, the rising power that chooses the West. Except they're not choosing the West anymore. They're choosing gold. I am Ken Au. Welcome to the vault. Today, India just voted no confidence in the dollar. And by the end, you'll see the 274 tons they're hiding in Mumbai. We just received the latest Treasury International Capital data, the TIC report, the official record of who owns America's debt. And buried in the numbers is a structural shift that Wall Street is trying desperately to ignore. Between October 2024 and October 2025, India aggressively slashed its holdings of US Treasury securities by nearly 21%. In absolute terms, the Reserve Bank of India liquidated approximately $50.7 billion of US debt. Their holdings collapsed from a peak of $241.4 billion down to $190.7 billion in 12 months. This is not a seasonal fluctuation. This is not a minor adjustment for currency intervention. This is the first sustained annual decline in 4 years. And crucially, it is happening in a market environment that defies traditional economic logic. Let me show you why this doesn't make sense. This wasn't supposed to happen. Currently, US Treasury yields are hovering between 4.0% and 4.8%. For a central bank manager, this is an attractive risk-free return. Historically, when yields are this high, foreign central banks accumulate bonds to lock in the income. They buy the yield. Think about the context. In 2020 and 2021, 10-year treasuries were yielding 0.5% to 1.5%. Central banks were desperate for any return. They bought everything. Now yields are triple that level, 4.5% guaranteed. No credit risk. Backed by the full faith and credit of the United States government, the deepest, most liquid market on earth. Every textbook says, buy now, lock in the yield. India is doing the opposite. They are selling into the yield. They are voluntarily walking away from a 4.5% guaranteed return in the world's reserve currency. They are choosing to hold less of an asset that pays them $10 billion per year in interest income. That is not normal behavior. That is alarm behavior. When a central bank sells a high-yielding liquid asset, they are making a statement about risk, not return. They are stating that the return on the bond is no longer high enough to compensate for the risk of holding the asset. Risk of what? Default? The US has never defaulted. Inflation? US inflation is currently at 2.5% to 3%, well below the yield. Currency depreciation? The dollar is strong relative to most emerging market currencies. So what risk are they pricing in? Political risk? Confiscation risk? Weaponization risk? This is a strategic divorce. Let's check the balance sheet. Is India selling because they are broke? Are they selling because they need the cash to defend a collapsing currency? The data says no. India's total foreign exchange reserves are sitting near record highs of $686 billion. They're swimming in liquidity. The rupee has been relatively stable compared to other emerging market currencies like the Turkish lira or the Argentine peso. Therefore, this selling is not driven by necessity. It is driven by choice. They are selling because they are de-risking. They are actively, methodically reducing their exposure to the US dollar system and the potential weaponization of the US Treasury market. The RBI governors in Mumbai watched closely what happened in February 2022. They saw the United States and Europe freeze $300 billion of Russia's sovereign assets overnight. $300 billion of central bank reserves rendered inaccessible. For India, which maintains a fiercely independent foreign policy, buying oil from Russia, weapons from France, and technology from the US, this was a wake-up call. They realized that holding $240 billion of US debt is not a safety net. It is a kill switch. If India refuses to align with US sanctions in a future conflict, the $240 billion could be frozen with a single Treasury Department order. The quiet exit is India's answer to this threat. Unlike China, which is dumping debt potentially to fund a war chest, India is dumping debt to build sovereignty. They are seeking to ensure that their national savings are immune to the whims of Western foreign policy. This represents a massive blow to the US Treasury's funding model. For decades, the US assumed that as developing nations like India grew richer, they would automatically buy more US debt. That assumption is now dead. India is growing. It is the fastest growing major economy in the world, but its purchase of US debt has reversed. If the fastest growing economy on earth isn't buying our debt, and the second largest economy, China, is selling our debt, who is left? India is voting with its feet. If India isn't holding US Treasuries, what are they holding? If they are selling the risk-free asset of the paper world, what are they replacing it with? The answer is physical gold. But the story here is not just that they are buying gold. Every central bank buys gold. The story is that they are moving it. And the scale of this movement is staggering. We're not talking about a few bars being transferred for accounting purposes. We're talking about chartered cargo planes, military escorts, high-security convoys moving through Mumbai at night. Physical bars weighing 400 troy ounces each, stacked in reinforced pallets, being transported from one vault system to an entirely different jurisdiction. This is a logistical operation that costs tens of millions of dollars. Insurance alone for moving 274 tons of gold is astronomical. The security requirements are immense. You need armed guards, armored vehicles, dedicated flight crews with top-secret clearance. Why would any central bank go through this expense and risk unless they fundamentally no longer trusted the custodian? To understand the magnitude of this shift, you have to understand the deep, almost traumatic history of India's relationship with gold. In 1991, India faced a severe balance of payments crisis. The country was days away from defaulting on its external debt. Foreign exchange reserves had dropped to less than 2 weeks of import cover. The situation was desperate. To secure an emergency loan from the Bank of England and the Bank of Japan, the Indian government had to physically airlift 67 tons of its national gold reserves to London and Tokyo as collateral. It was a moment of national humiliation. The family silver, or in this case gold, had to be pawned to save the state. Images of the gold being loaded onto cargo planes appeared in newspapers. The collective trauma ran deep. For the next 30 years, even as India recovered and became an economic powerhouse, a massive portion of its gold reserves remained in London, sitting in the vaults of the Bank of England. It was kept there for convenience. It was easier to trade, easier to lease, easier to use in the Western financial system. It was financial gold, paper gold, a ledger entry. But in 2024 and 2025, the Reserve Bank of India initiated a massive covert logistical operation to reverse history. They decided to bring the gold home, someone new. According to recent disclosures, India has repatriated approximately 274 tons of gold between March 2023 and September 2025. 274 tons. That's 8.8 million troy ounces. At current prices, that's over $25 billion worth of metal physically moved across the world. In the first half of fiscal year 2025 alone, they moved 64 tons from the UK to high security vaults in Mumbai and Nagpur. This is one of the largest physical transfers of gold by a major central bank since Germany, and the Netherlands did the same a decade ago. As of late 2025, over 65% of India's gold reserves are now held domestically, within the sovereign borders of India. That percentage was under 40% just 3 years ago. Why does this matter? Why go through the logistical nightmare and security risk of flying hundreds of tons of metal across the world? Because gold in London is a financial asset. It is a ledger entry. It is subject to UK law. It can be leased out, rehypothecated, and crucially, it can be frozen. If the UK government, acting in concert with the US, decides to sanction India, that gold in the Bank of England vaults becomes inaccessible. It becomes a number on a screen that you cannot touch. Gold in Mumbai is a sovereign asset. It is under the direct physical control of the Indian military and the Central Industrial Security Force. It cannot be frozen. It cannot be sanctioned. It cannot be leveraged by Western banks. By moving the metal, India is removing the counterparty risk of the West. They are effectively saying, we do not trust the Bank of England to hold our wealth anymore. We don't trust the rules-based international order to protect our property rights. And while they are moving the old gold, they are aggressively buying new gold. The RBI's total gold reserves have surged to approximately 880 tons. They were the second largest net buyer of gold in the world last year, behind only China. Gold now makes up nearly 14% to 15% of India's total foreign exchange reserves, up from just 7.4% a few years ago. The value of this gold hoard has crossed $100 billion for the first time in history. Let's look at the trade again. They sold $50 billion in US paper treasuries. They built a $100 billion fortress of gold. This is a textbook collateral swap. They are swapping unsecured liability, US debt, which relies on the US government's ability to pay, for secured collateral, gold, which relies on physics. This is the behavior of a nation that expects the global financial system to fracture. This move was prepared. A central bank does not go through the expense and risk of repatriating gold if they believe the world is heading toward greater integration and peace. They do it when they fear fragmentation, conflict, and the breakdown of trust. India is preparing for a scenario where the paper claims of the global system might not be honored. They're securing the physical foundation of their currency. This repatriation is a signal that the trust era of globalization is over. The era of physical possession has begun. And India is not the only one. But they are the loudest signal because they are supposed to be a strategic partner of the West. When your partner starts taking his money out of your bank and hiding it under his mattress, you know the relationship has fundamentally changed. Why is India doing this now? Why the sudden urgency to unwind treasuries and repatriate gold in 2025? The timing is not accidental. It is deeply connected to India's broader geopolitical strategy and the shifting tectonic plates of the global order. The RBI has explicitly stated in its reports that this diversification is driven by geopolitical risks and the need to insulate the economy from external influences. In central bank diplomatic speak, this is a shout. Translation: they are preparing for a post-dollar world. India, under its current leadership, envisions itself as the leader of the global south, the Vishwa Guru, the world teacher. They are positioning themselves as the third pole in a multipolar world, distinct from the Western Bloc, distinct from the Eastern Bloc led by China. To play this role, India needs to be able to trade with everyone. They need to buy oil from Russia. They need to attract investment from the UAE and Saudi Arabia. They need fighter jets from France and technology from Silicon Valley. To maintain this strategic autonomy, they cannot be held hostage by the US dollar payment rails. If the US places secondary sanctions on entities trading with Russia, and India is holding $200 billion in US treasuries, India is vulnerable. The US Treasury can effectively shut down the Indian economy by blocking swift access or freezing assets. By swapping treasuries for gold and holding that gold domestically, India becomes sanction-proof. They can settle trade in rupees, dirhams, or even gold, bypassing the US banking system entirely. Gold is the ultimate neutral reserve asset. The $50 billion exit from treasuries is the funding mechanism for this independence. The $50 billion exit from treasuries is the funding mechanism for this independence. They're liquidating the asset of the old hegemon to fund the architecture of their own sovereignty. This is where the system starts leaking. This represents a structural shift in global finance. It means that the natural bid for US debt from emerging markets is dying. For 30 years, the model was simple. Emerging markets export goods to the US, earn dollars, and buy treasuries to keep their currencies cheap and their reserves safe. That model is breaking. Now, as India grows, it doesn't just buy treasuries. It buys gold. It buys infrastructure. It invests in its own digital payment stack, UPI, the Unified Payments Interface, which processes billions of transactions monthly and is being exported to other countries. This removes a massive pillar of support for the US deficit. If the developing world stops recycling its surplus into US debt, the US must find new buyers. And as we've discussed, the only buyers left are the proxy buyers: hedge funds in the Cayman Islands, speculators in Belgium and the UK, and ultimately the Federal Reserve itself. The exit of the real money investors like India forces the US system to become more leveraged, more fragile, and more dependent on money printing. India knows this. They're getting out before the dilution destroys the value of their reserves. They are engaging in a non-aligned hedge, betting that the future will belong to those who hold hard assets, not those who hold the debt of fading empires. They didn't expect this move. Let me show you what the numbers actually mean for the US funding crisis. Let me show you what the numbers actually mean for the US funding crisis. The US Treasury needs to sell approximately $2 trillion of new debt per year just to fund the annual deficit. But it's worse than that. In addition to new deficit spending, the Treasury must also refinance maturing debt. In 2025, approximately $9 trillion of US debt is maturing. Add the $2 trillion deficit, total financing need, $11 trillion. That entire amount needs buyers. Historically, foreign central banks bought 30% to 35%. Domestic institutions bought 25% to 30%. The Fed bought 15% to 20%. Hedge funds and retail bought the rest. But that structure is collapsing. Foreign central banks are now net sellers. China sold over $100 billion in the last 18 months. India sold $50 billion in the last 12 months. The foreign bid is dying. Domestic institutions are constrained, but pension funds and insurance companies are already overallocated. That leaves two buyers: hedge funds and the Federal Reserve. Hedge funds are using leverage. They borrow dollars at 5%, buy bonds yielding 4.5%, and pray the Fed cuts rates. This is the carry trade. It's unstable. It collapses the moment volatility spikes, borrowing at 5% to earn 4.5%, losing 50 basis points on every dollar. The only way this works is if bond prices rise. It's financial alchemy. It only works in a world of stable, declining rates. The Federal Reserve is the buyer of last resort. When no one else buys, the Fed prints money and buys the bonds itself. This is monetizing the debt. It's inflationary, it's destructive, and it's inevitable if India and China keep selling. Every $1 billion that India sells must be replaced by leveraged hedge fund money or Fed money printing. The system is becoming a house of cards. Time is running out. Let me show you the real risk, the risk that nobody is pricing in. What happens if this trend accelerates? What happens if India's $50 billion sale becomes $100 billion next year? What happens if Saudi Arabia starts selling? What happens if the UAE follows? We enter a scenario where the only buyer of US debt is the Federal Reserve. And when the only buyer is the entity that prints the currency loses all credibility. This is the path to hyperinflation. Not next month, not next year. But the seeds are being planted right now. And the central banks see it. That's why they're buying gold. That's why they're repatriating the metal. That's why they're building alternative payment systems. They know the dollar system is terminal. They're just getting out quietly before the panic starts. If this continues, the price won't be the real problem. The movement of gold from London to Mumbai is a physical signal. It is a flash of lightning on the horizon. It means trust, the invisible glue of the financial system, is eroding. You need to watch for other countries doing the same. Are there rumors of Saudi Arabia moving its reserves? Is Germany accelerating its repatriation program? Are nations in Africa or South America demanding their metal back? If this trend accelerates, the quiet exit becomes a bank run. If every nation demands physical delivery of their gold from London and New York simultaneously, we will discover that there isn't enough metal to go around. The paper gold market will collapse, and the price of physical metal will decouple and skyrocket. That is the moment the system breaks. That is the moment you want to already have your position secured. India just unwound $50 billion in US Treasuries. They didn't do it for profit. They didn't do it because they were broke. They did it for survival. They are building a gold-backed firewall against the volatility and weaponization of the West. They watched Russia get frozen. They watched sanctions become a weapon. They decided they would never be vulnerable to that. The hidden buyers, hedge funds, and proxies absorbed this selling for now, masking the impact. But the message is clear. The East is leaving the building, and they are taking their gold with them. By the time the headlines admit it, it will already be too late. Here's what you need to understand. This is not just about India. This is a template, a blueprint, a signal being watched by every finance minister and central bank governor in the developing world. Every emerging market that watched what happened to Russia is now quietly reassessing its exposure to the US dollar system. They're asking themselves, are we next? Could our reserves be frozen? Could we be sanctioned? And the answer increasingly is yes. If you don't align with US foreign policy, your dollar reserves are a hostage, not an asset. So they're diversifying, quietly, methodically, without announcements, without press conferences, without alerting the markets until it's too late to react. They're selling treasuries, buying gold, repatriating the metal, building alternative payment systems, opening currency swap lines, negotiating bilateral trade deals that bypass the dollar entirely. India is just the loudest signal because they're big enough to move the needle, because they're the fifth largest economy, because they're supposed to be the West's ally. But the trend is global. Brazil is building payment systems with China. Russia and Iran are trading in non-dollar currencies. The UAE is accepting yuan for oil. Saudi Arabia is exploring alternatives to the petrodollar. The US Treasury market is losing its natural bid. The buyers are walking away. And the only replacement is leverage and money printing. This sets up the mother of all financial crises. Not today, not tomorrow. But the fuse is lit. The dynamite is packed. And we're just waiting for the spark. When the leveraged hedge funds that are currently buying treasuries get margin called, when volatility spikes and their carry trades blow up, when the Federal Reserve is forced to step in and print trillions to prevent a bond market collapse, that's when the dollar cracks. That's when inflation goes from 3% to 10% to 20%. That's when trust evaporates. That's when the game ends. India sees this. They're positioning ahead of the crisis. They're moving from paper to metal, from promises to physics, from financial assets to sovereign assets. They watched Russia lose $300 billion in a single weekend. They saw how quickly reserves can be weaponized. And they decided they would never be vulnerable to that. The quiet exit is the loudest warning you're going to get. Because when India sells, it's not just about the 50 billion, it's about the signal. It's about what happens when the rest of the developing world follows. When Brazil sells, when Indonesia sells, when Mexico sells, when Saudi Arabia sells. The US needs $11 trillion in financing this year. If the foreign bid disappears entirely, where does that $11 trillion come from? The answer is the Federal Reserve. The answer is the printing press. The answer is inflation. The answer is the destruction of the dollar's purchasing power. And by the time CNBC admits this is happening, by the time the Treasury Secretary holds a press conference to reassure markets, by the time Congress holds hearings about the loss of reserve currency status, the physical gold will be gone. The vaults in London will be empty. The vaults in New York will be drained. And the price of the metal still sitting in those vaults will be 10 times higher than the paper price on your screen. India just unwound $50 billion in US Treasuries. They repatriated 274 tons of gold. They built a $100 billion fortress of metal in Mumbai. They didn't do it for profit. They didn't do it because they were broke. They did it for survival. They watched Russia lose $300 billion in a single weekend. They saw how quickly reserves can be weaponized, and they decided they would never be vulnerable to that. The East is leaving the building, and they are taking their gold with them. The smart money is already out. The central banks are already positioned. The only question is, are you?